The, m- the money market and the capital market are two fundamental components of the financial system, each serving distinct purposes and catering to different financial needs. The money market specializes in short term borrowing and lending, typically involving instruments with maturities of 1 year or less. In contrast, the capital market focuses on long term financing and investment, dealing with securities such as stocks and bonds that have longer maturities or no fixed maturity at all. This distinction in time horizons defines their roles and participants within the broader financial ecosystem. One key difference lies in the types of instruments traded. The money market includes instruments like treasury bills, commercial papers, certificates of deposit, and repurchase agreements, which are highly liquid and low risk. These instruments are primarily used by institutions and governments to manage short term cash flow requirements or park surplus funds temporarily. On the other hand, the capital market facilitates the issuance and trading of equity and debt securities, enabling companies to raise long term capital for expansion, research, or infrastructure projects. Investors in the capital market are typically more focused on long term returns and are willing to take on greater risks compared to those in the money market. The participants in these markets also differ significantly. The money market involves central banks, commercial banks, corporations, and other financial institutions that require short term liquidity. In contrast, the capital market attracts a broader range of participants, including individual retail investors, institutional investors, mutual funds, and corporations looking to finance long term growth. While the money market emphasizes safety and liquidity, the capital market is geared toward generating wealth and fostering economic development. Another distinction is their relationship with economic policy. The money market plays a critical role in monetary policy implementation as central banks use it to influence short term interest rates and control liquidity in the economy. The capital market, however, is more closely tied to the health and performance of the economy over the long term, reflecting investor confidence and providing a platform for wealth creation and capital accumulation. Together, the money market and capital market form a cohesive financial system that supports both immediate and long term financial needs. While the money market ensures stability and liquidity in the short term, the capital market drives economic growth and innovation over time by connecting savers with long term investment opportunities. This complementary relationship highlights their importance in fostering a well functioning and balanced economy.